Hey everyone, how you doing today? As I published my content schedule yesterday, we do something every day. Monday through Friday, we bring on our experts and we start the week strong with Greg Dickerson. How you doing, sir?
Doing great, Michael. Coming in from the road once again.
I love that. I mean, it's such a wonderful thing to have experts that care so much about doing this every week that they're willing to meet us on the road. So I just want to thank you for doing that.
Yeah, well, I'm out here looking at progress. So, just flip the camera around. You see a little silt fence out there and
Yep.
equipment moving around. So,
Got to make sure people are doing the job, huh?
got to get on it. Got to get on it.
Well, hey, one of the things I wanted to talk about first with you, because both of us have been doing this for quite a while, is I'm just completing my tax prep for my accountant, and I'm to the point where I can start going back and looking at past performance. And one of the things that I thought was interesting is with all the talk about 2020 being a rough year for landlords, specifically mom and pop landlords, this is obviously month to month rentals. It's actually not my worst year. The worst year to be a mom and pop landlord was actually '06, right before the
Now,
bubble
what do you
burst.
what do you mean by that? When you say worst year, what do you mean by that?
Performance of my apartments, right? Apartments were not profitable in '06. I lost money in multifamily in '06 because turns were up. People were breaking leases and buying homes. And it was really just all the turns. And then I had to give rent, um, not rent, like incentives, like 1 month off and half off deposit. It was horrible. '06 was rough. 2020 was not nearly as bad from a numeric perspective, at least in our portfolio from rent collection.
And you
Apartments,
were primarily single family.
no, I would say numerically speaking, we're probably 60-40, 65-35, numerically speaking, but gross rents, it's far closer to 50-50, right? Houses rent for more than apartments. But yeah, 2020 was, when you look at collectively, houses were awesome. I think we had one tenant out of all of them that was kind of sketchy, but we got somebody else paid their rent, right? One of the agencies. But yeah, multifamily was rough, but I was surprised to see the data show that '06 was worse than 2020. I don't know what you remember of '06, but I thought I'd ask you what you remember because it's very different than I expected.
Well, that's when the housing market peaked, oh 04, oh 05, oh 06, during that time frame for single family homes, that was the peak of the market. So, it's really interesting. And I wonder if your financing structure has something to do with that, or could have something to do with it. Because interest is so cheap now that you can cash flow darn near anything because the
Yeah,
money's almost free.
that's true.
But it's all cycles, right? It's all up and down, and every market's different. So what you were seeing in your market there may or may not be indicative of what we saw in other markets.
True.
And inventory levels, the demands. We know the population has increased since then. We know that the renter demand has increased with millennials, graduating. I mean, they're the biggest portion of the market. They're probably the biggest, home buyers out there right now. So there's a shift from renter to home buyer, those types of things. So it's, without knowing all of the details, it'd be hard to say. But in general, I think the rental market was fairly strong in multifamily, oh 04, oh 05, oh 06, during that time frame. A lot of people were on the precipice of losing their homes going into the oh 07, oh 08 time frame.
Mhm.
So it's really interesting. I think, a lot of people, home ownership was on the rise, right? There was a big push to get everybody in a house. There were all those interest free, or not interest free, but no doc loans, things like that. So maybe there was pressure because it was easier to buy than it was to rent back then. It was almost cheaper to buy than rent, at a period. So I mean, there could have been a lot of factors affecting it, but that was probably it. It was probably because there was a huge push to get people into houses, and a lot of people were buying homes, during that time period.
Yeah, and that's exactly what it was. I remember several conversations where if somebody were going to move into one of my nicer apartments, they'd have to bring in like $2,500, right? First month
Hmm.
deposit, maybe a pet deposit or something, but they could get into a home for zero. I mean,
Yeah.
it was that market. So it started in '05 where we lost kind of the best tenants, mean at least financially best stable. But by the time '06 came, again, very California, very my market specific, it seemed like every other person was becoming a first time home buyer. And
And
obviously
it'd
that
be
reversed.
interesting.
Go ahead.
It'd be interesting to go back and track that. But I think that's when interest only LIBOR started, the no doc loans started, all that kind of stuff. I think it was that 05, 06 timeframe, because remember, the market started tailing off. And, we'd reached a peak 04, 05, going to 06, 07, a lot of other areas, reached their peak then. But that's when all of these financial instruments were created and when all of that started. And it didn't take long for all that to blow up either.
Mm-mm. Yeah, that vintage of loan product. I mean, I did a lot of reading on that a decade ago, and that '06 vintage of toxic CDOs and all of that, those were the worst. I mean, without question, they were just bad product. But that, an operating a business in that environment, I suffered. And now let's be clear, '07, '08, '09 were great years to be landlords in multifamily because everybody came back, rents went up, supply. I mean, it all came back. But again, myopically speaking, my tax return income and expenses and net in '06 versus 20, even adjusting for unit count, um, multifamily was rougher in '06 than 20. The other thing I want people to realize, I looked at my portfolio from '06 all the way to 20 in houses. Single family homes have performed every year. They've never had a bad year, and it's all been pretty consistent. Actually, obviously rents are up about 50% over that time. And if you have fixed rate debt, you're really enjoying life. So that's another takeaway I had is houses have been very stable cash flow units. And then obviously
Yeah.
you refi debt from 6.5 to 3.25, it's even better.
Well, with multifamily, there was a lot of pressure put on multifamily back then because there was a lot of development going on, a lot of building, a lot of new properties being delivered, to the market. So I think that, depending on where you're at, had a big impact on existing inventory.
Yeah. And again, the reason I bring all this up, just trying to help people understand that in some time frames, bigger isn't better, right? When I look at my portfolio, the bigger units I had, the worse performing. It was almost linear. The more units in the building, the worse it performed.
Mm-hmm.
It's just
Wow, that's interesting.
It's just how the numbers worked in 2020. And again, it doesn't normally go that way. There are times where the more units it performs the best, right? It's linear the other way, but 2020 was not that year. And I just thought it was interesting. In '06, were you just doing houses? You were doing big houses, right?
Yeah, and commercial. So
You
I was
were, okay.
developing land. I was doing some subdivisions. I was doing commercial. So I was doing a little bit of everything back then.
Did the toxic debt, that environment, impact your buyers? Because you probably didn't see that in commercial, I would guess.
No, no, because again, it was easy to get, the money back then. I mean, the financing was super simple, and that's where we're going to talk about another segment, in terms of, how I would structure deals into deals. But,
Mhm.
I had a building company that was the general contracting arm for me as a developer. So, I would end up with no money in my deals because I would hire my building company. Everything was done on loan to value, not loan to cost. So
Mm.
that was the other big thing too, is that anybody could borrow money, no doc, no income verification, none of that. It was the project, the money was loaned on the project based on the value of the project after it was complete, not the cost. So as the builder general contractor, I had tons of equity. So I would go put a piece of property under contract, commercial or residential, and I'd get a loan from the bank. The bank would loan me a percentage of the after, the finished value of that project. I had about a 20 to 30% margin in it. I'd get the company would get a 10% working capital deposit from the bank when the deal closed. The seller would get paid for their land. So I essentially got my profit up front
Mm.
for doing the project. So I didn't have to bring any equity in because it already had the equity built in.
Wow. Now, would that same loan product that was available then be available today? Just trying to tie out.
No,
Okay.
no, not at all. No, everything is loan to cost now, not loan to value, either loan to cost or loan to value, whichever is lower.
Got it.
So if the value is lower than the cost, you're going to get a loan the lower amount. But they never go higher anymore. On development, they want cash in the deal. Back then, it didn't care if the equity was there; they didn't care about the cash.
Interesting.
You could
Okay.
get non-recourse a lot easier now. You've got to have a lot of equity in the deal, and you've got to be strong to get non-recourse on development unless you're doing agency debt, and then that's a different animal. For multifamily, that's basically the only non-recourse development debt for the average developer out there right now. And then the no doc thing, that's all gone away. I think the closest thing we have now is bank statement loans for self-employed individuals. They'll look at your bank statements to verify your income instead of a W-2 or tax returns, things like that. So that's the closest thing we have, but still you got to put your down payment up. You got to have the credit score. and your interest rate's going to be a lot higher. Whereas back before, really all you needed was a decent credit score.
Yeah. So the last thing as we wrap up this session, I just want people to realize when I look at 2020, multifamily is where I saw rent softness. Houses actually rent went up. Vacancies went up in apartments, zero vacancies in houses most of the year. I think I had like, I think I counted, I think I had like 27 days of vacancy for the entire year across the portfolio. So basically nothing.
Yeah.
Bad debt or, tenants in eviction moratoriums are all in apartments, not in houses. So again, that's what I saw in 2020. It'll be interesting to see what other landlords had to say about what they saw in 2020. So Greg, appreciate this first conversation. I look forward to the next one.
Yeah.